Let me ask you something. When did you last open your mutual funds fact sheet? And not just to check the returns, but opened it to see where your money is actually sitting in. Most of us never do that. And honestly, that's understandable. Returns feel like the only number that matters. But here's something worth thinking about. Two funds can show you the exact same 5-year returns, and one of them could be rock solid, while the other one could be quietly reshuffling every few months, taking on way more risk than you realize. It's the same number from the outside, but very different story within. So we did the homework for you. We pulled the latest fact sheets of 3 of India's biggest mutual funds, compared April and May 2026 data, and we are going to show you not just what these funds returned, but how they are actually built, what changed, what didn't, and what that means for you as an investor. So let's get right into it. So we have picked one fund from all the 3 different categories. From the Flexi Cap space, we've picked Parag Parikh Flexi Cap. From Mid Cap space, we've picked HDFC Mid Cap. And from Small Cap, we've picked Nippon India Small Cap. All 3 of these were chosen based on AUM, which is basically the size of the fund. The bigger the fund, the more interesting it is to see how they manage all that capital. But a quick rule of thumb before we start. Mid Cap and Small Cap funds must keep at least 65% of their money in their respective categories as per SEBI rules. Flexi Cap funds also need 65% in equities, but they can freely move between large, mid and small cap stocks. Alright, so let's first start with Parag Parikh Flexi Cap Fund. So we pulled the May 2026 fact sheet, and the first number that jumps out is the AUM itself. It is 1.42 lakh crore. A month ago, it was around 1.38 lakh crore. So money is flowing in continuously, which tells you investors trust this fund. Now here's the investor angle on that number most people miss. When a fund gets this large, most opportunities become too small to make a difference. A 200 crore bet means nothing when you're sitting on 1.42 lakh crore. So the manager's real job shifts from just finding good stocks to figuring out how much of each to own. At this scale, position sizing becomes just as important as stock picking. And from what the portfolio shows, this fund manager gets that. Let's quickly look at the manager too. Rajiv Thakkar has been running this fund since day 1, 2013. He has over 30 years of experience in capital markets. When you look at how he's built this portfolio, it really shows that. Now let's look at what the numbers told us. Beta stands at 0.60. This basically reflects how sensitive the fund is to market movements. When the market falls 10%, this fund historically falls less. It simply doesn't react as violently to market swings. Standard deviation is under 10%, so the returns don't jump around wildly month to month. Sharpe ratio is 0.89. This tells you how much return you got per unit of risk taken. The higher, the better. Next is portfolio turnover, which has dropped to 17.17%, which shows the manager isn't constantly swapping players in and out. And then comes the expense ratio, which is 0.53%. For a fund this large, that's very investor friendly. So if you put all of this together, the overall picture looks like this. This fund is not trying to top every short-term return chart. It's playing a quieter, longer game. But now let's see what actually changed between April and May. And this is where it gets interesting. We put both fact sheets side by side, and not a single stock entered or left the portfolio. The holdings list is identical. But if you look closer at the weightages, you can see small but deliberate shift. HDFC Bank came down slightly, 7.94% to 7.88%. Power Grid came down from 6.99% to 6.41%. Meanwhile, ITC moved up from 5.43% to 5.84%. ICICI Bank went from 4.92% to 5.11%. And HCL Technologies and Zydus Life Sciences also saw small increases. But one important nuance to note here is, when a fund's AUM is growing, these weighted shifts don't always mean buying or selling. Sometimes it's simply how new incoming money gets spread across existing holdings. Cash exposure dropped from roughly 15.5% to 14.8%. That means some capital was quietly put to work in the market. And then there's the one thing that makes Parag Parikh completely unique, the international angle. About 12% of the portfolio sits in global stocks. No other major Indian flexi cap fund does this at this scale. Alphabet is the largest international holding at 4.83%, Amazon and Meta at 2.51% each, and Microsoft at 2.22%. And comparing April to May, there were almost no changes at all. Now let's look at the sector split too. Banks lead at 20.13%, technology, power, automobiles, and consumption follow. No single sector is carrying the whole weight. The mix looks balanced here. And this is how the the returns look like? We looked at rolling returns, which is a much more honest way to measure a fund than just point-to-point numbers. The 3-year rolling average here was 19.23%, 5-year 19.36%, and 10-year was 19.10%. Benchmark across these periods averaged around 15%. So all in all, consistent outperformance over a decade without taking wild risks to get there. Now let's look at the next mutual fund, which is HDFC Mid Cap Fund. AUM as of May 2026 is approximately 97,350 crore. Expense ratio on the direct growth plan is around 0.73%, which is reasonable for this size. Now because mid cap stocks are less liquid than large caps, so managing close to a lakh crore in this space is genuinely harder than it looks. So entry and exit decisions matter a lot more here. Now let's look who is the fund manager behind this one. Parag has been running this fund since its launch in 2007. Nearly 30 years in portfolio management. Same manager, same fund, almost 2 decades. Now let's look at what exactly changed between April and May. Very little, and that's the story. Core holdings like Max Financial Services, Federal Bank, Indian Bank and Balkrishna Industries all are still in place. The manager hasn't touched what's working. Cash actually moved up slightly from 6.54% in April to 7.5% in May, a slight uptick. This can signal that the manager is being selective, waiting for the right opportunities before deploying new capital rather than buying just to stay fully invested. Now this is how the sector breakdown looks like. Banks at 15.35%, then pharma, auto components, IT and industrials all with meaningful presence. What's interesting here is how spread out the allocation is. No single sector is doing all the heavy lifting. The risk metrics also tells a similar story. Beta of 0.82 for a mid-cap fund which by nature sits in higher risk territory, this is measured. The portfolio doesn't amplify market swings as aggressively as you might expect. Now the standard deviation is around 15.9%. Yes, there is volatility, but that comes with mid-cap territory, but you need to be compensated for it. Sharpe ratio is approximately 0.99, which is nearly 1. That means for almost every unit of risk you took, you got back a unit of return. That's strong quality. Portfolio turnover is just 4.55% in May, extremely low, confirming that the stability you see in the holdings isn't accidental. Now returns look good too. 3-year returns around 22.72%, 5-year around 21.01%. In a category where one bad cycle can erase years of gains, crossing 20% in both periods is a real reflection of execution quality, not just luck. Now let's move on to the last fund, Nippon India Small Cap Fund. This one had a very different April to May story. Let's look at it. AUM jumped from 69,045 crore to 74,604 crore in a single month. 5,500 crore of new money flowing in. And the manager now has to figure out how to put it to work in the small cap space without overpaying or disrupting what's already there. The manager here is Samir Raj, who has been managing this fund since 2017. 25 plus years in equity markets. Small cap investing demands deep research and real patience, and his tenure reflects both. Now let's look at what all changed here. Unlike the other two funds, Nippon India Small Cap made real portfolio moves in May. Now new stocks that entered the portfolio in May included Sun Pharmaceutical, ICICI Prudential Life Insurance, Exide Industries and Bharti Airtel. And then there were some exits too, Siemens Energy India, Raymond Realty and ITC. And what's notable is that the new entries aren't from one single sector. They are spread across pharma, insurance, telecom and industrials. The manager is deliberately broadening the bench, not concentrating on one theme. And the changes within existing holdings look like this. TD Power Systems increased from 1.54% to 1.71%. Apar Industries went from around 1.49 to 1.55%. HDFC Bank and Multi Commodity Exchange saw small trims. But here's how we read all of this. It doesn't look like a strategy change, it looks like thoughtful fine-tuning. New faces have come in, but the team's identity is the same. And even with 5,500 crore of new inflows, cash went from just 2.74% to 2.90%. The manager didn't rush to deploy all of it. Some liquidity was kept aside. That's a sign of discipline. Now let's look at the risk metrics here. Beta is 0.84. For a small cap fund, which is the highest risk equity category, this is composed. So the portfolio isn't chasing every market swing. The standard deviation is around 19.55%, the highest of the 3 funds we looked at today, and honestly this is expected because this is small cap. Sharpe ratio is 0.72. The fund is generating returns for the risk it's taking, but the quality score is lower than the other two. In this category, that's the trade-off you're accepting. Portfolio turnover is around 0.19 times. This is the lowest of the three and possibly one of the most underrated signals in this entire analysis. The manager is holding positions with real conviction. Expense ratio is around 0.54%. For a category that needs research across hundreds of small companies, this is fair. Now, if we look at the sector breakdown, electrical equipment leads at 9.6%, auto components at 7.7%, industrial products at 6.7%, consumer durables at 6.4%, and banks at 6.2%. So, multiple sectors, multiple opportunities, the portfolio isn't betting everything on one story. Now, the returns. 3-year returns is largely in line with benchmark. 5-year returns are around 21.80%. Benchmark was at 17.11%. Since inception, 24.01% annualized returns. That's not a hot streak, that's a long track record. So 3 funds, 3 completely different personalities. And here's what these 3 portfolios actually tell you. Parikh is the patient architect, nothing rushed, nothing reactive, long-term positions and global diversification, and a fund that doesn't feel the need to prove itself every month. Next, we talked about HDFC Mid Cap, which is more like a disciplined executor. Stable lineup, rising cash buffer, very low turnover. Then Nippon India Small Cap is the active builder. More moves, broader bench, but still with low turnover, which tells you these aren't impulsive decisions. Now honestly tell us, do you want us to cover this regularly? If yes, please comment mutual funds and we'll build a series around this. And also, which funds do you want us to cover next? Tell that also in the comments. If you like this video, do give it a like and subscribe to the channel if you already haven't. See you in the next one.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.